Good afternoon, everyone. I'm CS Yogesh Kumaja, currently serving as an Executive Academics in the Institute. It is my pleasure to welcome you all in the 28th session of EEE 4.0 Master Knowledge Series, which is focused on enhancing board effectiveness and role of committees. Board of Directors plays a crucial role in overseeing and guiding the strategic direction of any organization. An effective board is one that only ensures compliance but also adds value through governance, strategic decision making, and risk management. To maximize the effectiveness of the board, the role of the committees become essential. On the other side, board committees are designed to handle specific governance functions more efficiently, allowing the full board to focus on strategic issues. Committees provides a focused, efficient mechanism for overseeing critical aspects of governance, making it easier for board to manage its workload and responsibilities. Now to delve deeper into the critical aspects on ways to enhance the board effectiveness and the role played by the board committees, today's session is scheduled, and for the detailed deliberation, we have us CS Ramaswamy Kalidas, practicing company secretaries. It is an honor to be given the opportunities to introduce him before all our learned members. He is a fellow member of Institute of Company Secretaries of India and MBA in Finance from Jadavpur University, Kolkata. With more than 4 decades of experience in industry after starting professional career in the year 1978, currently he is practicing as a practicing company secretary. He worked in a leading companies such as Ambuja Cements, ACC Limited. He also served as a company secretary and senior vice president Reliance Power Limited for 7 long years. He authored more than 100 articles on issues related to corporate law, SEBI regulations, and corporate governance. Currently, he is associated with ICSI as a member of Secretarial Standard Boards, SSB of the ICSI. It is our proud privilege to have such an eminent speaker for today's sessions and get benefited from the word of wisdom in this technical area and his brief profile. We welcome him at the 20th session of EEE 4.0 Master Knowledge Series and hope to have enthusiastic learning. And the participants, you are requested to raise their queries, and same will be taken up at the end of the session. So welcome, sir.
Thank you. Good afternoon, everyone. Namaskar. At the outset, let me thank my alma mater for giving me an opportunity to interact with the members on what I think is a topical issue for coffee table discussions, namely the role of board, the role of committees, and how the role of the committees can be enhanced so as to achieve the ultimate objective of enhancing the levels of corporate governance. Having said that, before I start my presentation proper, there are 2 disclaimers I wish to make. One is that, there are certain views I might be expressing during the course of my articulation, and these views are entirely personal and do not in any way represent the views of the Institute. I might even differ where it comes to certain issues from the Institute's official line, and therefore this disclaimer is extremely important. And the second is that I would be drawing the attention to people about best practices adopted in companies, but for obvious reasons, I shall not mention the name of the companies. And the third thing which I want to be specific about is that while I shall field all the questions that you have in mind, what I would suggest is that you can put your questions in the chat box, and at the end of it, assuming that we go on for about, what is the time till which I'm supposed to speak?
For at least 2 hours or 1 hour, 30 minutes, we can.
Yeah, say supposing I'm supposed to speak 2 hours, let's say I will break off at 4:45, and then we'll have a Q&A session where I shall take all the questions that have got accumulated in the chat box. Right. Having said that, let's have the presentation rolling, and I hope we have an interactive and invigorating session, sharing knowledge and experience through and through. Thank you. Let's have the slide, please. Yeah, the topic for discussion, as I said, is enhancing board effectiveness and the role of committees that play a crucial role in increasing the effectiveness and efficacy of the board. The first slide, please. Now, every topic for discussion which is taken in corporate law, it's important that we start from the beginning. From the etymology, it's important to understand the origin associated with the expressions used in law, because that give an insight as to what led to the introduction of that particular concept in law. So etymologically speaking, let us try to understand. Etymology, incidentally, is the science or the art of deducing the origin associated with the usage of words. The term committee is actually is an extension of the expression commit, which was used in the late 15th century, and primarily it referred to, in common parlance, it referred to somebody who's committed, who's a person to whom something has been entrusted. In other words, there is a certain underlying commitment that the person to whom a particular responsibility has been entrusted will discharge his responsibilities, and hence the expression commit. Now, the legal lexicon has this to describe provide the definition of a committee. According to Black's Legal Dictionary, 7th edition, a committee is referred to as a group of people. Mind you, we originally talked about a person in singular. Here we are referring to a group of people appointed or elected. Either they are appointed ex officio, or alternatively, they are elected to consider, determine, or manage a particular matter of significance. Obviously, you're not going to be discussing through the formation of a committee the weather, but you're going to discuss something more vital and crucial, and which has a huge ramification insofar as the functioning of a corporation is concerned. Now, the other definition has been given in Ramanathan Iyer's Concise Law Dictionary, where he refers to a committee as an assembly. I mean, of course, today in the era of technology, where meetings are possible through virtual audio-visual means, it is no longer restricted. A meeting is no longer necessarily leading to an assemblage of persons. It's an assemblage or board of persons to whom the consideration or management of any matter is committed. There again, you'll see that the expression committee has been emphasized upon, and the reference is to an aggregation of people who are going to discuss a problem which is of a common nature. Now, the Supreme Court, in the context of Amul, Gujarat Cooperative Milk Marketing Federation Limited, defined a committee as a governing body of a society to which the direction and control of the affairs of the entity are entrusted. Indeed, the court referred to the committee as a governing body, in as much as we are not looking at a company. Gujarat Cooperative Milk Federation Limited, was originally conceived as a cooperative institution, and therefore it was a society, and hence the expression is restricted to a governing body of a society. Having said that, let's go on to the subject proper and identify the purposes associated with the formation of committees. Next slide, please. Yeah, what is a committee? As we can see, the board of directors is an assemblage of persons whose responsibility it is to steer the company through the choppy waters of a dynamic ecosystem. Now, in as much as the board has diverse activities to look at and to focus on, to ensure that there is a focused attention on specific areas which are of crucial importance and which substantially impact the operation of a company. Can you go back to a second slide, please? Yeah. Okay, remain here. Next slide, next slide. Yes. Inasmuch as the board has a plate full to attend in terms of areas of activity, it is important that the board sets up small groups so as to enable such groups to have a focused and undivided attention on matters which are of crucial importance and which impact very substantially the operations of a company. And there are certain committees which are mandated under law, and there can also be certain committees which can be voluntary and created for the facility of discharge of responsibilities. The basic intent associated with the formation of committees is, as I said, to facilitate focus on strategic areas of importance, and it's a given, ceteris paribus, as they say in economics, other things remaining unchanged. A committee is supposed to, unless of course the committee is not going to discharge its activities in the manner in which it is contemplated or envisaged, the setting up of a committee is essentially it provides an assurance to the board as to governance, as to good governance, because in a committee you are involving harnessing specialized skill sets for attacking specific issues. And as I said, there is no bar to setting up voluntary committees, because one principle in law that one must always be aware of is that what is not prescribed in law, law does not prescribe any panacea for everything. What is not prescribed in law is not necessarily proscribed. In other words, it is not prohibited as long as what is intended to be done is within the compass of the law and it is not repugnant to the objective for which the law has been enacted. Now, having said that, the first salvo which I wish to fire as a matter, as a point for discussion, is we have agreed that a committee is a subset of the board. So therefore, is it proper to call a meeting of the independent directors as a meeting of the board committee? Now, our secretarial standards 1 says that a meeting of the independent directors is not a meeting of the committee. Indeed, the standard says that the application of the standard shall be extended to committees set up by the board, but where it comes to the independent directors meeting, it is not necessary to apply the secretarial standard 1. Now, I am inclined to be slightly different where it comes to my viewpoint on this. To my mind, a meeting of the independent directors is actually mandated under law under Schedule 4, and there is a specific agenda that is to be discussed by the board. And given the fact that independent directors constitute a subset of the board, to my mind, it should be considered as a committee. It should be committed. It's not necessary that a committee should bear the extension, the term committee. But in as much as it is a meeting of a particular class of directors, namely the independent directors, I am inclined to take a view that a meeting of the independent directors is a meeting of a committee. And the standard also goes on to say that there is no necessity of maintaining minutes of the meetings. Here again, I am inclined to differ in the sense that the objective of the independent directors meeting is to firstly discuss discuss the performance of the directors, then also discuss the role of the chairman, evaluate the value of the quality of disclosure that is provided in terms of secretarial documents, in terms of the agenda for the meeting. And considering all that, to my mind, it is important that the chairman gets a feedback from the independent directors as to the quality of discourse that emanates in the boardroom. And in fact, where I worked last in ACC, we invariably had the minutes of the meeting of the independent directors circulated for the consumption of the entire board, notwithstanding the fact that it could have thrown up some surprises and some issues may not have been entirely palatable. In fact, there is also no harm if the board considers it expedient and necessary. There is no harm in having more than one meeting of the independent directors in a year, although the law mandates that at least one meeting shall be held in a financial year. Now, I am aware of several companies which have meetings of independent directors, three, four. In fact, the one company I know of has a meeting of the independent directors which precedes every board meeting. Next slide, please. Next. Next slide. Yeah, let's now look at the committees which are to be set up mandatorily. There are committees which are to be set up mandatorily under the provisions of the Companies Act as also under the SEBI regulations. Some committees are common to both legislations, and one committee is specific to LODR only, and one committee is specific to the Companies Act alone. Now, the committees which have to be set up under the auspices of the Companies Act as also the SEBI regulations, assuming that we are talking about a company which is listed or which has listed its equity or it has got it's a high value debt listed entity. Companies which have the committees which have to be set up under the Act and the LODR are the Audit Committee, the Nomination and Remuneration Committee, the Stakeholders Relationship Committee. These three committees are mandated by both the Act as also the SEBI regulations. And where it comes to the Risk Management Committee, the LODR provides for the appointment of a risk management committee in case of those companies which have the top 1,000 companies determined on the basis of their market cap. And of course, where it comes to banks and other institutions which are regulated by RBI, there is a requirement in the case of banks to have, notwithstanding whether the company constitutes one of the top 1,000, notwithstanding that it is necessary for a NBFC or a bank to set up a risk management committee under the mandate of the Reserve Bank of India. And where it comes to directions of the RBI, and where it comes to the CSR committee, in as much as CSR is an obligation not restricted only to public companies but even to private companies, only the Companies Act has a mandate insofar as the constitution of a CSR committee is concerned. Next. Audit committee, if you want to trace back the legacy of the legacy associated with the constitution of the audit committee, the requirement of the audit committee was actually specified in the Companies Act of 1956. In fact, through an amendment in the Act in 2000, the requirement of an audit committee was made necessary. Of course, in terms of application, it was only restricted to listed companies, and therefore the impact was pretty much limited, and it was only in the main confined to the listed entities. However, under the Companies Act 2013, given the fact that the new act is essentially intended to elevate all round the levels of corporate governance, the requirement of an audit committee has been extended not only to a listed public company but also to unlisted public companies which satisfy any one of the following threshold, which have a paid up share capital of 10 crores or more, or a turnover of rupees 100 crores or more, or a borrowing of 50 crores or more. And these thresholds have to be determined with reference to the last audited financial results of the company, last audited financial results, And if you are talking about a public company, now supposing you have a private company which is a listed, which is a subsidiary of a public company, given the extension to the term public company, even a private company which is considered as a, which is a subsidiary of a listed company, would also be falling within the ambit of the requirement of an audit committee, subject, however, to fulfilling any of the three thresholds which have been stated. It's important to note that the thresholds laid down above are mutually exclusive. Mutually exclusive in that if you satisfy any one of the thresholds, the requirement for setting up of an audit committee arises. Now, and at this juncture, it is important to understand the significance associated with the usage of the word, usage of the conjunction or and in the law. Now, when the expression, the conjunction or is actually a disjoining conjunction, and it is intended to, separate clauses that are intended for application, and therefore once you have a section which says that so and so will apply if any of these conditions apply, that means that or being a disjointing conjunction, you will fall within the vortex of the compliance if one of the conditionalities are satisfied. On the other hand, and is actually an aggregative conjunction, and it kind of aggregates. And supposing in place of the word or you had and everywhere, then all the three conditions would have had to be satisfied for you to set up an audit committee. Namely, you would have had to have a paid up capital of 10 crores and above, and a turnover of 100 crores and above, and a borrowing of 50 crores or above. But given the fact that the expression or has been used in the rules which provide the threshold for the formation of an audit committee, if you satisfy one of the criteria, it is good enough. And then indeed under LODR, the requirement of an audit committee applies not only to an equity listed company but also to HBDL LCS. That means high value debt listed entities or companies. Next. Now, the terms of reference of the audit committee. Now, you see, if I kind of try to explain threadbare the terms of reference, given the fact that I am addressing the members who are well conversant with the law, it would be somewhat similar to carrying coal to Newcastle if I labor on the basics. So, therefore, I shall, rattle off the terms of reference, and where necessary, I shall articulate and based on my experience of what I have seen of the way audit committees function. Under the Companies Act, the terms of reference of the audit committee are the recommendation of the appointment, remuneration, and the terms of the statutory auditors. Now, the audit committee has to recommend and also recommend the remuneration as also the terms and the conditions associated with the appointment of the statutory auditors. Now, where it comes to recommendation, you could, the audit committee could also make use of a due diligence check. You could appoint an external agency and identify a few firms and determine their qualitativeness in terms of certain specific parameters, and based on that you could zero down on the committee, on the firm that is to be appointed. And similarly, where it comes to remuneration, one important area which serves as a benchmark for determining or recommending the remuneration is what has been paid to the previous incumbent. Of course, that applies only in the context of an existing company, but otherwise, if you are going to, I would suggest that you see, where it comes to curiously, corporates are very happily parting with large amounts of money where it comes to legal solicitation. But when it comes to audit, including secretarial audit, they are very finicky with their money. and want to extract like Shylock their pound of flesh. To my mind, it would be incorrect for you to sort of try to economize on the fees payable, because after all there is no compromise which is allowed where it comes to the quality of audit, and one should never be sort of finicky where it comes to the quantum of fees, and you should never compromise quality at the altar of cost, right? The audit committee will only have the role to recommend, it cannot appoint. Then it has to review and monitor the independence of the auditor's performance and the effectiveness of audit. Now, how does this get accomplished? Now, as I have seen in practice, what happens is that when the audit committee meets, before the discussion in terms of the agenda starts, invariably you have one item which is tagged to the audit committee's agenda, namely the approval recommendation of the financial results quarterly, and of course for the financial year. So what you normally do is that you have a one-on-one discussion with the auditors. It could be either the chairman of the audit committee having a one-on-one, or preferably the entire audit committee could have a discussion with the auditors and understand from them whether the management is cooperating where it comes to provision of all the information, whether there are any deterrents that are being placed in their path, so as to ensure that there is an unhindered discharge of the responsibility. And the effectiveness of the audit will also be determined by and by in terms of the improvement in the quality of the controls, in terms of the improvement in the quality of disclosures, and so on and so forth. Then the third responsibility is the examination of the correctness, the true and fair view of the financial statements has to be examined by the audit committee, and based on that conclusion as to whether the accounts reflect the fair and true view of the state of affairs of the company, the board of directors shall take a call on approval of the results, be it for the quarterly as also for the financial year. Now, auditors' reports are also extremely important to be analyzed at the level of the audit committee, because there are any issues which are to be thrashed out before the report is finalized. These could be done at the level of the audit committee, and it is important for the audit committee to articulate on the auditor's report. And if there are the era of qualifications is over. I mean, today, if there is any disquieting in knowledge or information which is shared by the auditors, it is referred to as a modified opinion. And if the auditors have expressed certain modified opinion on certain items in the accounts, which they are very much entitled to, it is the onus of the audit committee to support, to help draw up the board's comment on the responsiveness or the reaction to the modified opinion provided by the auditors. Then we have to the next very important area of involvement of the audit committee is the approval and modification of related party transactions. The audit committee, this is the only area where the audit committee has the authority to. I beg your pardon, not the audit committee. I'll have my view on this today. When it comes to a listed company, the related party transactions have to be approved only by the independent directors who are members of the audit committee. So every related party transaction and any modification thereto in the terms of the related party transactions have to be approved by the independent directors of who are members of the audit committee. And of course, in order to ensure that the audit committee is not overburdened by approving every transaction, there is a provision for seeking omnibus approval, and for that purpose, the omnibus approval is normally granted insofar as transactions which are of a repetitive nature, and there is a certain value band which can be determined by the board, and the policy with regard to provision of omnibus approval has to be based on the recommendation of the audit committee and approved by the board. And now, as I said, there has previously the responsibility of approving related party transactions was entirely with the audit committee. But in 2021, there has been an amendment to LODR by which the responsibility of approving related party transactions is now entirely with the independent directors who are part of the audit committee. Now, you could have independent directors who are not part of the audit committee, in which case those independent directors who are not part of the audit committee shall not be engaged in dialogue where it comes to approval of the related party transaction. Now, this, to my mind, is analogous to setting the cat amongst the pigeons, because independent directors. Firstly, let us understand who are they. Independent directors are non-executive directors, and they are not supposed to be doing an executive function. And to my mind, if you are, again, this is my personal view, if you are approving a related party transaction, you are willy-nilly doing an executive function, which is anathema where it comes to the independent directors. Secondly, the independent director is a visitor to the boardroom once in a quarter. Now, whether the independent director has the commercial bandwidth to evaluate a related party transaction is a matter of conjecture. Now, I'll tell you from experience. When ACC was a part of a conglomerate, international conglomerate called Wholesome. Today, it's part of Adani. Now, several transactions involving purchase of inputs for cement manufacture like pet coke, etc., would be decided internationally. I mean, it would, the Wholesome board would decide on the parameters to be applied for purchase of items on a large scale for cement plants across 91 destinations in the world. Now, there will be so many parameters which should be considered, such as exchange gain, such as availability of substitutes, and so on and so forth. And very little contribution will be made by the directors or by the audit committee once the policy on that had been set. Basically, it made sense to source such items because the economies of scale would be applicable in such a case, and therefore the audit the directors, the independent directors particularly, didn't have much bandwidth when it comes to assessing the commercial wisdom associated with the related party transaction. So I'm not sure whether by placing the onus on the independent directors to approve of a related party transaction, are you doing justice to their responsibility? And that has given rise to another situation where independent directors today, although the law does not say so, the audit committee's decision or the independent director's decision with regard to a related party transaction is also placed with the board, so that the board ultimately decides, which is not the intention in the law, right? But this is a matter which, to my mind, I feel very strongly agitated where it comes to giving the onus of approving a related party transaction to independent directors. And third thing, which is a corollary to this situation, is the fact that if there are independent directors who are part of the audit committee, there are independent directors who are not part of the committee, it necessarily, unwittingly creates a wedge within the body of independent directors, and that's entirely not palatable. Right? You might say that the world over, I mean, the practice is to have independent directors only in the audit committee. In that case, let us have a law which says, like you have even in India, if you issue special equity a special rights equity, the audit committee has to consist of independent directors. Then let's have a situation where the entire audit committee is comprising of independent directors, in which case this situation will not be given rise to. Next. The audit committee has to also recommend to the board any transaction other than those which are covered under section 188 where the committee does not approve. Curiously, you would perhaps I am I do not know how many of you have observed that whilst there is a definition for a related party transaction under the LODR regulations, there is no definition of a related party transaction under the Act. Of course, Section 188 speaks about certain 5-7 categories of arrangements or contracts. Now, that is not necessarily the be all and end all of related party transaction, because 188 does not refer to financial obligations. Whereas, if you look at LODR, related party transactions include transfer of resources. It's not transfer of goods alone, and therefore if you are transferring money to another company which is a related party, that also comes within the ambit of a related party transaction. Now, therefore, the audit committee has to recommend to the board any transaction other than those that are covered under Section 188, where the committee does not approve. The committee does not approve of any transaction which is not covered under 188. It can recommend that the board may take a decision, take a call on this. Now, the Companies Act exempts transactions between a holding company and a exemption. There is an exemption insofar as transactions between a holding company and a wholly owned subsidiary, except for transactions under Section 188, right? And then the other area where the audit committee has to involve itself is where it comes to scrutiny of intercorporate loans and investments. Now, the committee has to see whether the loans which have been granted by the board under Section 186, whether these loans are being serviced, whether the interest on the loans is not lower than the rate that is chargeable for government security of specific tenor, whether the investments that the company has made are yielding returns in the form of dividend or interest if it comes to debt instruments. And very important area of discussion and decision by the audit committee lies in the valuation of undertaking. Supposing you are contemplating the disposal of an undertaking, or you are considering a demerger or a spin-off of assets. In that case, a valuation has to be done of the assets or the undertaking by an independent valuer, and it is important for the audit committee to assess the qualitativeness of the valuation made for such exercises. Now, when you are making an IPO, typically it is always the case that a monitoring agency is appointed by for the purposes of monitoring, unless of course the IPO is intended for general working capital purposes. There is a monitoring agency which is appointed for the purposes of identifying the end use associated with the funds that have been raised on a public on a public offer. And the audit committee has to be provided a quarterly report on the end use of the, and if there are some deviations from the end use for which the funds have been raised, then it is important for the audit committee to come back on to roll back and then ensure that there is no misuse of funds. And the funds are indeed used for the purposes entirely for which they have been raised. And the audit committee also has to seek the comments of the auditors where it comes to internal controls. Internal controls here include both internal controls as a whole, and also internal financial controls where it comes to listed companies. And how does the audit committee elicit the response of the auditors? They, as I said, you have a one-to-one dialogue with the audit committee, with the auditors. The team of the audit team as also the signing partner and you want to understand what are the observations that they have made, why they have made these observations, whether the accounts are in consonance with the accounting standards which have been prescribed. And then it is also important that there is a dialogue which is on a continuous basis with the internal auditors. The internal auditors are, they are the nerve center where it comes to assessing the qualitativeness of the internal control systems, and therefore it is important that the report of the internal auditor, be it an internal resource. You can appoint an internal auditor as an internal resource, as an employee, in which case he shall be reporting functionally to the audit committee, and he shall be only reporting administratively to the managing director. But you should therefore have, as an audit committee, discussions. The internal audit reports are placed before the audit committee, and there has to be a discussion, and action points have to be raised by the audit committee on matters which have been red flagged, and so that there is a these come to a logical conclusion. Next. The audit committee has also the responsibility to investigate into matters which have been either thrown up by the auditors as also by the internal auditors. I mean, if there are certain concerns or consternations which have been expressed where it comes to the quality of control, or there is ineptness where it comes to financial management or accounting controls, or any area of improvement is called for, the audit committee will have the responsibility to investigate into such matters, and where necessary it can take professional guidance also. Professional guidance, as in, is not restricted only to seeking guidance of the auditors, but from outside agencies. I mean, if you have a complex tax issue that needs to be understood thoroughly by the audit committee, then you might engage a tax expert. And now, it's very important to know that the committee shall have full access to the company records. Financial records of the company will have to be fully made available, if necessary, at the behest of the audit committee. And where it comes to, you see, an audit committee cannot function without an interface with the CFO and without an interface with the auditors. Now, therefore, it is typically essential for the CFO or the person who is in charge of the accounts to be present at the audit committee, so that he gives his views on various matters concerning accounts. But in as much as the CFO is not a member of the audit committee, nor is the auditor, they shall only have the right to be heard, but they shall not have the right to be they shall not have the right to vote. They will only have the right to provide their views, but they shall not have any decision making authority, and that is left to the audit committee. Now, the composition of the audit committee has also to be disclosed in the board's report, as also matters where the board has not accepted the committee's recommendations. In case there are matters where the committee recommendations have not been accepted by the board, then this has to be stated in the board's report, and you have to specify the composition of the audit committee. The composition of the audit committee is now two-thirds have to be comprising of independent directors, and now that raises another question, whether, you see, the law does not say specifically that an executive director cannot be part of the audit committee. There is nothing in the law which says that an executive director or should cannot be part of the audit committee. Now, that raises the question whether it is necessary for you to, whether you should appoint somebody who's an executive director as part of the audit committee. I am aware of one very large corporate which had appointed one of the managing directors as a member of the audit committee, but when it was articulated at length that as to the desirability of having a non-executive executive director, who can influence, if you have an executive director on the audit committee, he can, lead the discussion of the committee, which is not desirable. The committee has to be entirely independent, and therefore my submission is that, notwithstanding the fact that the law does not deter you from appointing an executive member of the board as part of the committee, to my mind, it is not welcome to have an executive director on the audit committee. Then the setting up of the vigil mechanism, which was earlier known as whistleblower policy. Now, listed companies and other companies which are raising deposits and borrowings in excess of 50 crores of rupees are supposed to set up a vigil mechanism or a whistleblower policy. Now, later in my discussion, I shall talk about some ingenious ways by which certain companies have made the vigil mechanism stronger. But what I have found in experience is that to make the vigil mechanism stronger and to ensure that employees participate wholeheartedly, three things you must do. Firstly, you should have a dedicated email ID which ensures that there is anonymity to the sender of the mail. Secondly, you should have a dedicated helpline number which should be administered by an agency outside your company, right? And thirdly, of course, this is provided in the law itself, there should be no question of any victimization insofar as the whistleblower is concerned. Suppose I raise a red flag, in no way should I be victimized or subjugated or subjected to certain stern action because I have blown open the lid. Next. The vigil mechanism, as I said, the vigil mechanism has to ensure that no victimization is, follows where it comes to blowers, and they have also the. You should provide access to the if it is a matter of grave consequence, if it's a matter of huge, magnitude in terms of volume, in terms of value, you should allow the whistleblower the access to the chairman of the audit committee also. And indeed, the terms of the vigil mechanism should be posted on the company's website. Next is the terms of approval, terms of reference of the audit committee as per the LODR. Now, the Sarbanes-Oxley legislation, if you recall, had clearly mentioned that apart from rotation of auditors, auditors should not be engaged in non-audit assignments. In fact, one reason why Enron fell was because of tax advisory by Arthur Andersen apart from the audit. Now, where it comes to auditors who are engaged for non-audit assignments, it is necessary to restrict such assignments. Auditors should not be ever involved in certification. And even if there are assignments which are non-audit in nature, these should be restricted to the bare minimum. And indeed, their engagement should be only with the approval of the audit committee. And the audit committee shall also approve the fees that are to be paid for the auditors who are taking up non-audit assignments. And the audit committee has the responsibility to review with the management the financial statements, the matters which are to be included in the board's responsibility statement. As you are aware, under section 134, there is a board's responsibility statement which has to be taken extremely seriously. If there are any changes in the accounting policies which are going to have ramifications on the financial results, the audit committee has to articulate with the management the rationale associated with such changes. What are the major accounting entries which involve the use of application of judgment, which because many a time, like for instance, if we are talking about contingent liabilities, originally contingent liabilities was a off-balance sheet disclosure item, but not any longer. Contingent liabilities, there is a requirement now, depending upon the probability of occurrence. I mean, supposing you're talking about a liability on account of a tax assessment. Now, if there are certain cases that are in favor in your favor, there are certain cases against. According to the balance of view that is available, it is necessary to assign a probability to the occurrence of such a liability and provide that liability in the books and not disclose that entirely as a contingent liability as an off-balance sheet item. Next. Compliance with regulations are indeed important. As I said, accounting standards are of mandatory application, and if there are any adjustment entries which have been made, their financial impact has to be assessed and explained to the board, and the rationale associated in case the audit committee approves of such adjustments should also be explained to the board. Now, how do you respond to the modified opinions? That means the qualifications of the auditors is another area where the audit committee has to engage itself, because the composition of the audit committee is such that you have to be you have to have as the chairman one who has got educational qualification in finance, preferably a chartered accountant, and then others are also supposed to be in a position to read the financial statements, and therefore they should be in a position to offer a view as regards the modified opinions that have been provided by the auditors. And the board's report now has a section called MD&A, Management Discussion and Analysis of the Financial Condition and Results. Before this is approved by the board, the review of this particular section of the board's report has to be made by the audit committee. And again, the audit committee has also to review the reports of the monitoring agency insofar as the utilization of the funds that have been raised through an IPO. And these reports have to be, as I said earlier, placed quarterly with the audit committee. Then there has to be a review as to the adequacy of the internal audit function. Now, if you think that your internal audit is, merely a rudimentary exercise, given the fact that internal controls are extremely important, particularly internal financial controls, you need to beef up the internal audit function either by appointing an external agency or by having a larger team. You should do that, because you see what is very important to understand is that while it may be expensive to hire such people, the cost of not having such people and tomorrow you have a time bomb ticking away is going to be enormous. I mean, it's absolutely disproportionate when it comes to the cost and the effectiveness. So the adequacy of the internal audit function, you have to discuss as a committee their findings, examine the weaknesses as pointed out by them, and what are the remedies that they are suggesting, whether the remedies can be applied, whether the loopholes can be plugged. All these will have to be matters which should engage the attention of the audit committee. And of course, you must review the findings of internal investigations which have been made on specific matters. If there is a forensic audit, if there is an investigation into this particular area, in God forbid, if the company is defaulting on meeting its financial obligations, the audit committee has to analyze the reasons why this is happening and ensure that it does not happen. Right? Next. Appointment. This is I find this to be an additional responsibility, because the responsibility of making a recommendation for the appointment of persons who belong to the senior management, higher echelons of management, is with the nomination and remuneration committee. But where it comes to the CFO's appointment, once the nomination committee has recommended the candidature for the appointment as a CFO, the appointment of the CFO has to be approved by the audit committee, and there has to be a proper assessment of his ability, because the nomination committee may not have the wherewithal to determine the qualitativeness of the candidature. Right? Next, where it comes to utilization of funds made by subsidiaries out of the loans provided by the holding company, if you have lent money in excess of 100 crores, or the money lent is in value exceeding 10% of the net assets of the subsidiary, whichever is lower, the utilization of funds by the subsidiaries out of the loans provided by the holding company has to be monitored by the audit committee. And where it comes to mergers, restructuring, corporate, demergers, spin-offs, etc., the cost benefit analysis, the rationale associated with mergers has to be determined. In fact, one very major stumbling block, when I was there in ACC, we were looking at a merger of ACC and Ambuja Cements. But what stopped the decision on that was the humongous amount of stamp duty that would be payable by both the companies in the event of merger. Because, cement plants are set up over large areas of land, and the stamp duty payable was humongous, and therefore it was decided to allow the companies to function separately. So you have to make a cost benefit analysis associated with the decisions on mergers. And now it is an important it's a mandatory requirement that the views of the audit committee has to be stated where it comes to justifying a merger. The board has to seek the views of the audit committee, and it has to be stated in the merger document that the audit committee has recommended the merger, right? And as I said before, you have to review the MD&A, management discussion and analysis. The approval, the removal, and remuneration of the chief of internal audit is also the responsibility of the audit committee. Of course, this is the case where you have an internal resource who reports into the audit committee, and as I said, only administratively to the chief executive officer. And you have to review the weaknesses in the internal controls as reported by the auditors. Next. Composition, as I said, the minimum composition is three. Minimum number has to be three, with the majority being independent directors, and the majority should have the ability to read and understand the financial statements. Where it comes to LODR, the requirement is that two-thirds of the committee shall comprise of independent directors, and if you have issued special right equity, in that case, all the members have to be independent directors. In the United States, the membership to the audit committee is allowed only to independent directors as far as from the year 1978. In other countries like South Africa, the King's report also states that you should have only members who are independent directors on the audit committee. So is the case in Canada. And all members have to be financially literate. And one person, of course, should have the accounting expertise. And the chairman of the audit committee has to be necessarily an independent director, and he should be present at the annual general meeting to answer the queries of the shareholders on the accounts. And this question I've already addressed, whether an executive director should be part of the committee. In my view, the answer is no. It's not desirable. Next. The company secretary is the secretary of the audit committee, and the company secretary is the linchpin where it comes to the entire process. I'll articulate further towards the end of my discussion what role the company secretary has to play where it comes to the activities of the committees. But he has to act as the secretary of the audit committee, and you can invite in times of need the director finance. The director finance should not be part of the audit committee, but you can invite him, or the CFO, the internal auditors, and of course the statutory auditors will have to be invited where it comes to the review of the financial statements. Now, the committee can also choose to meet without the executives. Either the committee can meet by itself, or it can have a one-on-one discussion with the internal auditors, or a one-on-one discussion with the auditors. In ACC, invariably, we used to have one meeting which was entirely reserved with the auditors for the purposes of assessing their independence. Now, what is the number of meetings? See, the minimum number provided is 4, although there is no limit as to the number. You can have as many meetings as you need. In fact, in case of banks, I find that number of audit committee meetings are much more. There was this, and the gap between two meetings should not, of course, exceed 120 days. Now, there was, if you recall, there was a proposal to introduce by the National Stock Exchange. The National Stock Exchange had in the year 2023 tried to introduce a prime listing, a listing segment which was prime, which extended the contours of corporate governance beyond the layers of law. I mean, corporate governance was being considered beyond the letter of the law, and with that in end in view, NSE had opened a special listing zone, but unfortunately, no company volunteered to be part of it, given the fact that the rigmarole associated with compliance with the norms laid down in Prime were far too rigorous for companies to follow. And the NSE Prime recommended that there should be 5 meetings at least, and one meeting of the audit committee should be exclusively intended for discussing the budget. Now, what is a quorum? The quorum today is one-third of the strength, total strength, or two, whichever is greater, with at least two independent directors being present. The prime security listing provided for a quorum, which was quorum was supposed to be constituted by the presence of the majority of independent directors. Okay, next. NRC. Next, we come to the Nomination and Remuneration Committee, and this again is a requirement for every listed company and every public unlisted company which satisfies the same thresholds as apply for an audit committee, which we have discussed, right? So I don't have to discuss the thresholds for the creation of an NRC where it comes to an unlisted public company. And this NRC would also apply to a private company which is a subsidiary of a public company, right? And now, when it comes to the composition of the NRC, as per the Act, the NRC should consist of 3 or more non-executive directors, out of which one half shall be independent directors. Now, there is a dichotomy in the law. If you look at the proviso to Section 178, if you look at this 178, one says that the composition shall be 3 or more non-executive directors, of which one half shall be independent directors. The proviso says that the chairman of the committee, whether executive director or non-executive director, can be a member of the committee but cannot chair the committee. So therefore, the proviso contradicts subsection 1. So to my mind, whether it is whether the proviso will rule or not is a matter of debate. But in my view, the chairperson, regardless of whether he is an ED or a non-executive director, should not be a member of the nomination committee. Should not be, because again this will vitiate the independence associated with the functioning of the committee. But the proviso to 178, as I said, clearly allows the chairperson to be a member, even if he is an executive chairman, but he cannot be a chairman, but he can be a member. So the dichotomy is very clear whether an executive chairman can be part of the committee. This is a paradox insofar as the proviso to Section 178 is concerned, since it contradicts the mother clause 178(1). Now, when it comes to LODR, the composition has to be NEDs. Again, LODR also suffers from the same drafting anomaly, where the proviso has been lifted from the Act, which talks about the chairperson being whether executive or not being a member. Now, but it again says that all members have to be NEDs, of which 2/3 have to be independent. Whereas this was previously for a unlisted company, it is one half, but for a listed company, 2/3 of the nomination committee has to be independent directors. The chairman of the committee has to be at least has to be an independent director. That goes without saying, because otherwise, as I said, it will vitiate the functioning of the committee. The committee shall meet at least once in a financial year, but there is no harm if the committee has to meet. In fact, to my mind, at least two meetings should be held. One for the purposes of evaluating the remuneration payable to the key managerial personnel and recommending the remuneration for the managing director, and the second one would be to discuss the modalities associated with the board evaluation. So at least there should be two meetings of the NRC. I have done the audit of companies which have 6, 7 meetings of the NRC. And like I said, what is not prescribed is not necessarily proscribed, as long it is going to lead to better governance. Okay. The quorum has to be one-third of the total strength, with at least one independent director being present. The chairperson has to be present at the chairperson of the committee has to be present at the AGM. It does not talk about general meetings. It only talks about the presence of the chairperson in the AGM, the nomination committee chairperson in the AGM. But it will be the decision of the chairman of the board to decide whether the chairperson of the nomination committee shall respond to any query from the shareholder at the AGM. Next. Now, the NRC has a wide spectrum of activity to cover. Firstly, it has to identify the persons who are qualified to be directors, and then it has also to identify those persons who can be considered as part of senior management as per the criteria laid. Now, senior management has been defined to mean defined to mean that layer of the management hierarchy which is one level below the board, and it also includes functional heads. Now, whether that will mean that you extend the concept of the senior management to include all departmental heads, I don't think you should stretch it beyond a manageable number. You should only have persons at the level of vice presidents and so on and so forth covered. The NRC has to recommend to the board the appointment and removal of directors and the senior management. How do they recommend the appointment? They recommend the appointment of a person to the board based today. Now LODR says that there should be at least two persons in the independent directors who should have core competencies, and the NRC, while deciding whether to take a new director or not, should identify whether that particular area where there is a need, whether that skill set where there is a vacuum is going to be filled up by the appointment of the new person, right? And again, where it comes to the appointment of senior management, the company secretary's appointment, the CFO's appointment, the whole-time director's appointment has to be recommended based on a review of the appropriateness of the candidature for the position. And removal again is the process which can happen based on poor responses, negative reports on performance, or not being able to meet the criteria. But to what extent you will, again, when it comes to removal of directors, now you see, how do you assess the performance of a director is again a matter of debate, because the directors, particularly the independent directors, are non-executive in functioning. But you can nonetheless make an evaluation based on how much how much they are contributing. Excuse me. Now, if a director, please understand, if an independent director makes a lot of noise and raises his voice of dissent, it does not mean that he is very efficient. It does not mean that he is, because you don't have to be. Independence is a state of the mind. You don't have to block the decision of the management to merely show that you are independent. If there is some decision which is in the interest of the company, you should not wear blinkers. The independent director should not wear blinkers. Now, determination of the performance evaluation. Now, this is, either you can do it internally through a process of there are some questionnaires which are raised for determining the parameters for evaluating the performance of the board and the individual directors. Or now the trend is to use external agencies who lay down the criteria. They have, their own way of assessing the performance. So you can take a call on whether you want or externally through an external agency. The Big Four are providing support. We had occasion to engage one of the Big Four for laying down the parameters for evaluation and to come to a logical conclusion as to whether the director at all performed. Now, the NRC also formulates the criteria for determining the qualifications, the positive attributes. Positive attributes, like I said, you don't have to block every resolution to prove that you are independent. Your independence is actually manifested by your supporting the board constructively. Criticism has to be constructive and in the interest of the organization. Next. Recommend to the board the policy on remuneration of directors and KMPs. Remember one thing, if you throw peanuts, you get only monkeys. So therefore, your recommendation insofar as remuneration policy should be such as to draw talent. It has to draw talent not only in terms. One of the reasons why the law has been amended to provide for remuneration to independent directors, even in case of loss-making entities, as per Schedule 5, is that an independent director's only way of getting remuneration, if it is a profit-making company, is sitting fees and a commission which is based on the net profits. If there was no net profit, then of course there would be only sitting fees. And now to ensure that does not, and there was a considerable vacuum which was being generated by the fact that directors did not find the remuneration to be attractive. That's why the law has been amended to provide for remuneration as per the effective capital as per Schedule 5, even in a case where the company has no profits or inadequacy of profits. So therefore, while drawing up the policy, the NRC has to consider whether the remuneration is reasonable. How do you determine whether it is reasonable? You will have benchmarks with your competitors, your peer groups. The composition has to consider there has to be a healthy balance between the fixed element and the variable element, which will reflect the objectives of the firm. If the fixed element is very large, there is hardly any incentive to perform. So there should be a healthy balance between the fixed and the variable element, so that the senior management and the directors are able to perform. And the remuneration has to be necessarily invariably linked to performance, and it should be allowed only when the performance indices are met. The performance benchmarks have to be met, and the remuneration has to be attractive, reasonable, draw talent, and finally it has to motivate performance. See, at the end of the day, if you look at the theories associated with human behavior, there is a theory which says that at the senior level, remuneration is only a hygiene factor. It's only a hygiene factor because beyond a point, remuneration does not matter, right? What matters is how much importance you have and what is the pivotal role that you play in the organization. Next. NRCs, we quickly run through the terms of reference as per the LODR. Devise the policy for board diversity and succession planning. This is extremely important. The board has to be diverse, comprising of people who are, educated in the area of law, management, in environment, in IT, technology, Succession planning is yet another area which is extremely important. That is why, I personally feel, of course, the day is over now. Previously, until 2024, you could have an independent director appointed for 2 terms under the new act, even if he were an independent director under clause 49 for donkey's years. Now, the proxy advisories do not consider somebody who had spent more than 2 terms, including the term which preceded the act, as independent. So therefore, succession planning has to be, ensured to find replacement for, if a director is in his second term, somewhere midway you should plan for a successor, and that is how you should ensure that there is gender diversity is also to be maintained. Unfortunately, companies are only appointing one independent woman director. There are, of course, a few exceptions where there are 3 4 women independent directors. In fact, the NSC Prime provided for the appointment of 2 women independent directors. And where it comes to appointment of independent directors, you are supposed to the NRC is supposed to prepare the description of the role and capabilities that are expected of the independent director. What is the skill set that is expected? What is the experience? You should ensure that this person is not too many companies, otherwise he is going to have a finger in every pie. And there is now a requirement that you should draw from the incumbent the commitment that he will be able to give the time that is necessary for the company. And you may engage an external agency for supporting the process of selection, and also consider, as I said, the time commitments of the directors, and develop the criteria for evaluation of the board. This, as I said, can be done either internally or externally through an independent agency. Recommend the continuance of independent directors based on performance evaluation. Identify who are the potential candidates for growth to senior management, appointment as directors. Remuneration of the senior management to the board has to be also another area. And of course, the NRC is responsible for administration of ESOPs. And now there is one question which has come in recent times, whether the bandwidth of the NRC can be extended to cover issues relating to POSH, labor policy, etc. Now, POSH, to my mind, I don't think you can cover POSH within the ambit of NRC, except by way of a reporting, because POSH calls for a specific requirement of compliance under the Act itself. But when it comes to labor policy, yes, the NRC can have an overview, considering also that now labor appointment of labor, particularly ensuring that you have a certain percentage of the differently abled persons, and you do not employ child labor, etc. Because of the requirements to report on these parameters under ESG, it has become necessary for the NRC to articulate increasingly on such matters relating to labor policy, as also POSH. But POSH, as I said, the NRC can articulate, but it cannot substitute the committees which are to be established under the law. Next. Stakeholder Relationship Committee. Now, this is a committee, sadly, which has, whose importance has diluted from the time the physical transfer of shares has been eliminated. And nonetheless, the requirement of the Stakeholder Relationship Committee exists where it comes to a company which has an investor base of 1,000 or more. Now, it does not necessarily mean that you have to have 1,000 shareholders. You can have 1,000 debenture holders also, in which case you should have a stakeholder relationship committee. Deposit holders also, if you have more than 1,000, you need to have the committee. and it is at any time. Suppose at any given point in time you have more than 1000, you have to appoint the committee even if the number falls below 1000 during the year. The chairman of the stakeholder committee has to be a non-executive director, and the others, I mean, the law is very flexible where it comes to the composition of the committee. The board can decide, but except for the fact that the chairman has to be an independent, a non-executive director, and you'll have to settle the grievances of the security holders. Grievances of security holders has reduced very substantially from the time when you have now you have board meetings through audio visual means. Otherwise, the typical complaint of the shareholder was that he has not received the annual report, he has not received the dividend. Now dividend is being distributed through NEFT. There is very little chance of dividend being missed. And I remember one shareholder, I mean, mercifully, come September 30, 2025, or maybe the law will be amended to provide for hybrid meetings. But there, I recall one shareholder in my company who had one 8 shares in eight. He had 8 shares in 8 folios, and he demanded that I should give him 8 copies, physical copies of the annual report, and each copy cost me 450 rupees. That was more than the amount of dividend that he was going to receive. So the number of complaints have been substantially reduced because of the era of e-voting, as also the audio visual means. And the chairperson of the committee has to be attending the general meetings, or in his absence he has to authorize any other member of the committee. Next. Resolve investor grievances, including the complaints relating to transfers. Of course, this is not there any longer. Non-receipt of annual report. This again is now an issue which is non-existent. Dividend again has also been substantially reduced. There is no question of issue of duplicates, except where it comes to stray cases involving transmission. And notices of EGMs or AGMs are now issued through email. And this is one area where you could leverage the purpose of the committee. Review the measures for the effective use of voting rights by shareholders. See, shareholders are typically not willing to participate beyond receiving their annual report and receiving their dividend. Now, they don't participate in voting rights because they do not, some of them do not understand. I'm not saying that now, because consumer shareholder activism, thanks to the proxy advisory, has increased substantially. But you can motivate your shareholders to vote. You can send them reminders to say that the voting opens on such and such date. You can if you want, you can give them a virtual lesson on how to use the module for e-voting, and so on and so forth. Then there is a need for also to review the adherence to service standards vis-a-vis the services rendered by the RTA. This again has reduced substantially in terms of importance because of the fact that physical shares are not any longer held. Then, one area where the committee can contribute is to reduce the quantum of unclaimed dividends and timely receipt of unclaimed dividends. Timely receipt of annual reports may not be a matter any longer if we continue with the mode of your virtual meetings. But it is important to educate the shareholder that he should open a bank account which allows NEFT. He should have net banking facility so that he is in a position to receive the dividend, and the unclaimed dividends do not accumulate, leading to a situation where it goes to the government of India, to the investor protection fund. Same is the case where it comes to shares. right? Next. The chair has to be NED, and the minimum, as I said, has to be three persons with at least one independent director being there, and the stake where you have issued a special rights equity, two-thirds of the committee has to be independent directors, and the minimum one meeting has to be held at least once in a year, and the chairperson has to be of the committee has to be present at the AGM. Some of the additional areas some companies have identified is that you have a periodic engagement with investors. You have an investors meet, like when you have a meet after your financial results, you could have a meet with the investors so that you can gauge their sentiments where it comes to how well or badly the company is functioning. There can also be an annual satisfaction survey of the investors, and you can review the IEPF transfers and take measures to reduce the number of transfers for the benefit of the shareholders. Next, risk management committee. This is not a requirement under the Act. This is a requirement under the LODR provisions, and there is the applicability of the RMC is only restricted to the top 1,000 listed companies based on their market cap and to the high value debt listed equities entities. The composition of the committee has to be there has to be a minimum of three members. Majority, mind you, this is one committee which allows a person who is not a member of the board to be a part of the committee. In other words, you can have as chief risk officer, as is the case in many companies, he is made a member of the committee. He is not a board member, but yet the law allows a person who's not a board member to be part of the committee. Of course, he shall not have the right to vote because he's not a board member, but he shall definitely, given the purpose associated with the formation of the RMC, it is important for you to have senior persons contributing to the functioning of the committee. So the minimum number of members has to be three, of which the majority will be board members with at least one independent director. And it is usual to appoint the senior management persons as part of the committee. Firstly, you will definitely appoint the chief risk officer, and apart from that, you might also appoint the CFO or functionaries such as them. Or if attrition is an important element in your organization, you probably might also want to have the HR head as member of the RMC. Where special right equity is outstanding, the committee should have at least two-thirds as independent directors. The chairperson of the committee has to be a board member. And the law, LODR, says that the committee should meet at least two times in a year, and the gap between the two meetings shall not exceed 180 days. In other words, we should have two meetings for each half year. And like I said, there is no premium where it comes to over compliance, and therefore there is no limit to the number of meetings that you can hold. Next. The RMC has a very, very important role to play because risk is not endemic to any business. Risk is an epidemic which applies to every business. Indeed, the risks are different. The risk could be technology, the risk could be non-availability of raw material, the risk could be non-availability of labor, the risk could be non-availability of land, the risk could be competition, the risk could be technology. In fact, I recall a discussion we had with Mr. Nandan Nilekani in 2018 when he beautifully articulated on how technology has usurped so many traditional industries. So you must be ready to. An organization is not here for the day. An organization is supposed to be eternal, and therefore to enable you to drive the organization through the vicissitudes of business, through the choppy waters of the economic system, which is dynamic, it is important that the board, the committee, articulates on the risks. What are the risks which you can control? Of course, Only risks which are controllable can only be subject to control. You cannot control a risk such as COVID. You cannot control a risk such as a flood. You cannot control a risk such as flood, earthquakes. But you can certainly control things which are controllable. Like, for instance, if there is a raw material which is not available, then you should try and source as much as possible, or probably find out a source. If there is a cyber risk, you must take steps to ensure that cyber security is beefed up, to ensure that there is no randomware, there is no cyber attacks, etc. Where it comes to sustainability, environment, how do today companies are not designed, are not measured in terms of their performance in financial parameters. We are looking at triple bottom line: concern for purpose, concern for people, concern for the environment, and concern for the stakeholders. So therefore, it does not do good only if you are going to make profits. Those days where Milton Friedman said that the business of business is to be in business is gone. A business has now not shareholders, it has stakeholders including the government, and therefore you must identify what are the risks. Risks should be divided into two parts: internal risk, external risk. What is the external risk? External risk is competition. External risk is technology, obsolescence of technological obsolescence. External risk is poaching of resource people. Internal risk is non-availability of raw material, poor productivity, poor quality of machinery, poor quality of raw material. So these are areas which, in fact, what is necessary is for the risk management committee is to identify the risks and give a weightage. And there is a you maintain risk registers. You have risk registers have to be maintained in a systemic manner, and the risks have to be weighed to ensure that maximum focus is given on on those risks which are crucial, which are necessary to be mitigated to the extent possible. So you must develop the wherewithal and the infrastructure to mitigate through systems, through proper systems and processes, risks which are controllable internally. And of course, you must have a business continuity plan. What is a business continuity plan? Business continuity plan is the development of the capability to sustain your business through the ebb and flow. Every business has a business cycle in the form of a depression, in the form of a recession, in the form of a boom. So your ability to tide over various situations. After all, business is like a roller coaster. It's like riding a tiger. You sit on the tiger, you may not be able to jump off. So unless you reach your destination, which is unending. So therefore, you must have a business continuity plan. And if you are a conglomerate with different activities, I would recommend the introduction of a matrix called the BCG matrix, that is the Boston Consulting Matrix, where businesses are bifurcated on the basis of contributions. Those businesses which contribute maximum value are considered as stars. Those that contribute least, you probably might have to weed out or dispose them of, and that is how harness your resources optimally in such a manner that you are able to maximize the advantage arising from the use of the resources which are very scarce. Use of like for instance in cement, you're not ever going to, it's not, limestone does not grow like plants. You have a limestone mine which has got a life for probably limestone resources for 20 years. Then what happens? Then you have to find other sources. So you'll have to have use of proper technology and methodology for the purposes of monitoring and evaluating risks. And you must take precipitatory action to ensure that risks that are controllable are mitigated to the extent possible. Next. The risk management policy adopted by the company has to be necessarily dynamic. So there is a need for you to review at least in once in 2 years the risk management policy, considering the dynamics of the business. And you must keep the board informed of the steps which have been taken, because it's a very interactive committee. This is a committee which is going to contribute substantially in the operational areas, and it is important that the board is informed of what are the steps that have been taken by the RMC, what are the recommendations, and the appointment and terms of remuneration of the chief risk officer is the domain of the risk management committee, much the same way as the CFOs is the domain of the audit committee. And the risk management committee has to work in coordination with other departments as per the framework laid down by the board. Okay, you have to necessarily work. If environment is a risk, you have to have engagement continuous basis with with the plant people. The processes have to be improved. You'll have to have machinery which is energy efficient, and so on and so forth. Of course, the employee members need not be paid sitting fees because they are members of the committee, but since they are not part of the board, they should not be paid fees. Next, please. This final committee is the CSR committee. This is a mandate not under the LODR, because the CSR is a requirement which applies to both listed as also rather private as also public companies, provided they satisfy the thresholds laid down under section 135(1). So there is no specific reference to the constitution of the committee under the LODR, and it has to be set up by both public and private companies which satisfy any of the thresholds laid down under section 135(1) during the preceding financial year. What is the threshold? The threshold is a profitability of 5 crores. Profit has to be determined as per 198, or a turnover of 1000 crores, or a net worth of 500 crores. If you are satisfying, again, since the word expression used in 135(1) is or, the conditions are mutually exclusive. So if you satisfy one of the conditions, then you have to have a CSR committee. But I fail to understand, if you don't have profit, you have the net worth, if you have the sales, what is the purpose which is going to be served by having a CSR committee? So, to my mind, the threshold should have been determined only on the basis of the net profitability. Now, again, the previous law provided that only companies which have existed for a 3-year period or more are supposed to have CSR spends. Unfortunately, the law has been amended now to provide that even fledgling companies, even companies which have started very new, they are, if they have the threshold profitability of 5 crores of rupees, then they are supposed to have CSR friends, they are supposed to have CSR spends. Now this, to my mind, is a retrograde step, because sustainability is an extremely important prerequisite to, as they say, charity begins at home. If your house is in order, then only you will look outside. So if your profits are not sustainable, why are you being asked to contribute to society as long as you have not reached sustainability? In fact, in economics, there's an expression which it says, "Nurse the child, nurse the child, care for the nurse the baby, care for the child, free the adult." So therefore, by that analogy, we should only have allowed companies which have got sustainability in terms of profitability to make CSR spends. But unfortunately, CSR has become a topic where the government wants the corporations to contribute the way it has to contribute for social welfare. And the amount of CSR spends, is humongous. I mean, I think this year itself it has crossed 13,000 crores for corporate India. There is the committee has to have at least 3 members, of whom one should be an independent director. However, there is no requirement for an independent director in the case of a private company which has to spend for CSR. In such a company, only two directors can constitute the CSR committee, and there is no requirement for the CSR committee to exist if your CSR spends do not exceed 50 lakhs of rupees, and this function can be discharged by the board. Now, I would advocate as a company, suppose you find a situation where you have a CSR committee and you find that this year your profitability has reduced to below 50 lakhs, do not dismantle the committee. To my mind, you should not dismantle the committee. Why? Because tomorrow you have again a situation where your profitability is more than 50 lakhs, then you have to have a committee. Then you go back to the board and tell the board that, sir, we need to have a committee. Now, whether a committee has to exist or not, to my mind, should not be something which is decided by the quantum of spend. The quantum of spend may be only 50 lakhs, but the quality of spend is what is more important. And therefore, if there has to be a proper focus on CSR spends, there should be a CSR committee, regardless of the quantum of spend. Now, the controversial Rule 3.2 has been withdrawn. What was this rule saying? If you had set up a CSR committee and for the next 3 years you do not satisfy the criteria for CSR spend, even for the next 3 years you had to maintain the CSR committee. Now, that was absolutely ridiculous. What would a CSR committee do when there is nothing to articulate? Would the committee be twiddling its thumbs? And mercifully, they have withdrawn. The high powered committee had recommended the withdrawal of Rule 3.2, and Rule 3.2 hence stands withdrawn. Next. The CSR committee has to formulate and recommend to the board the CSR policy, which will cover the essentially activities which are covered under Schedule 7. And there is a rider to Schedule 7. The government wants Schedule 7 to be read liberally. So you should not construe that, suppose rural, like for instance, it does not say rural housing is part of CSR, but housing is part of CSR. So it does not mean that rural housing you cannot do because it is not part of Schedule 7. In fact, the Q&A of the government clearly says that the CSR provisions, the Schedule 7 has to be read very liberally. Okay. Only those spends which are part of the business cannot be done. Suppose you have a health camp only for your employees, that cannot be considered as CSR, right? And you must recommend spends in those areas where the CSR committee has identified. Ideally, there should be 2 or 3 themes on which your CSR policy should be built. One could be health, the other could be sanitation, the third could be, the third could be in development of infrastructure and all that, right? And the CSR committee has to monitor the CSR policy from time to time and monitor the progress of different projects. Now, projects can be done through 3 ways. One way is directly, if the company is engaged in a project, you can do a CSR project with your own employee CSR department. The other is to have an intermediary through an NGO. Now, that is, you pay money to an NGO, tell them what they have to do, and they are supposed to spend money as per your directions. And the third and the most preferred, because it takes away all the headache associated with monitoring CSR spends, the third is to put the money quietly to the PM Cares Fund and get done with it, right? And then, of course, you can also collaborate. If you are talking about a large project, you can collaborate with other companies, with other NGOs, and set up a project where each company's fundraising is identified separately, right? And the CSR committee has to ensure that there is proper utilization of funds against identified projects, which is why now there is a requirement that if you provide money to an intermediary, an NGO, you must take from the NGO confirmations as regards spends. If the NGO, suppose you have put 10 crores of rupees with the NGO, and if the NGO has only spent 7 crores of rupees, the NGO is supposed to return 3 crores of rupees, which you have to put back into the unspent CSR account and use it. If it is for an ongoing project, you can employ it to an ongoing project, but you must monitor how well your funds are being used. And to my mind, this concept of spends, the spend is, see, accounting is based on accrual. Anything which is due is supposed to be received. Whether it is received or receivable is supposed to be accounted for. Similarly, the mercantile concept should have applied where it comes to CSR also, but sadly enough, now CSR is based on cash accounting, and if you do not spend whatever you have given to if the NGO has not spent the entire amount that you have given to it, the amount that has been unspent by the NGO will have to be will have to be given back to the company, and it has to be accounted for, and they ensure that the unspent amounts are used for ongoing projects, and these are the funds are properly parked. Don't put the money into FD. If you put the money into an FD, in that case there is an interest. In that case, the accretion that the yours, that interest will also have to be plowed back into the project. Ideally, it should be kept in current accounts so that the utilization is fast. Next. Seek periodic confirmations. The management has to seek periodic confirmations from the CFO as regards the spends. Now, how do you, if you are the CFO of, let's say, TCS, and I believe TCS engages over 100 NGOs. Now, how on earth is the CFO going to give the management a certificate with the confirmation with regard to spends? Now, therefore, he is allowed to depend on third party authorizations. He can depend on third party authorizations where it comes to uh, giving confirmations to the management. And where it comes to projects which are having an outlay of more than 1 crore, there has to be an impact assessment. And the impact assessment is ideally done by an outside agency. Now, the question is that the law provides for an impact assessment, but curiously, it does not provide for a need assessment. To my mind, need assessment should all, I mean, if you want to for do a project, you should firstly assess whether there is a need for that project. So need assessment should also have been equally a requirement under the law. And the board has to be periodically kept informed about the progress made on the CSR projects, and the information with regard to the projects will have to be also posted on the company's website. Next. Now, these are the committees which are to be set up under the law. Now, there are various other committees. As I said, there is no bar to having voluntary committees. Now, you could have a committee for ethics. Ethics committee is a committee which is, I've seen this happen. In fact, we had a committee in ACC also, which essentially what did it do? All the whistleblower complaints would be initially, screened by this committee, so that what went to the audit committee was something which was material. So you could have an ethics committee. Then you could have a legal compliance committee. Legal compliance committee is an extremely important committee because compliance is extremely crucial. Because if you are considering the cost of compliance, consider the cost of non-compliance. That will be humongous. So we used to, and now companies are increasingly resorting to tools, online tools for compliance management. Please invest in online tools by which you are able to, we discovered when I was in power, the total number of laws which need to be complied at the central level was 84. Now, how on earth are you going to ensure by manual mechanism whether there is legal compliance? Okay, so invest in a legal compliance tool. You can tailor make it according to your requirements, and we had suppose you have got many plants, then you could have a competition, healthy competition. We had a scorecard by which we we identified what was the extent of compliance. Now, compliance was not merely ticking the box. Please understand, compliance had to be demonstrated through actual action. So you could have a invest in a tool for legal compliance management. Then you could have a committee for sustainability and ESG, which is a, and then many companies have investment committee, because when you have got cash in excess of your requirement, when you want to make investments in, of course you cannot make investments into companies through a committee, because 186 provides for an approval by the board. But indeed, you can make investments in mutual funds through a committee of the board. And the secretarial standard will apply. Secretarial standard 1 will apply to both mandatory committees as also to committees which are non-mandatory. And the board should allow the free play of interplay with the committees. It should encourage the independence of committees and avoid interference to scuttle functioning. The board should not say, "I am the boss." The committee should be allowed to function. Otherwise, you are doing something which is dysfunctional to the functioning of the organization. Next. Now, you see, the institute has an excellent publication. I think I'll display it on the screen. The institute has an excellent publication. I don't know how many of you have read this through. This is a marvelous publication. Of course, I'm selfish in adulation by saying that I had a hand in this publication. This is a best practices manual on corporate governance, and there are some practices which I have picked up from this, which can be emulated, because as I said, you don't have to, compliance is not something which is ticking the box. You have to have compliance which is which is substantial. Compliance has to be in substance, not necessarily in form. So you could have some of the learnings which I have picked up from this book is, you can have a audit committee which consists of only independent directors. In that case, you don't have to have the situation of non-independent director being present in the audit committee and not being able to articulate on the related party transaction. Review, I'm not giving the names of the companies because the names of the companies has been given in the manual. Review non-audit exercises by auditors and ensure that these exercises do not conflict with their independence. Limit the number of non-audit exercises by the auditors and ensure that they are not in conflict with their independence. Provision of audited quarterly results. You will be astonished to know that only 8% of the listed companies provide audited quarterly results. There are two companies which I can name straight away. Infosys is one, and the other is Infosys has my good friend as a company secretary, and then the other is, I think, Wipro. So, let us have situations where results can be. Today, there is no problem about having the most sophisticated accounting manuals, accounting, packages. So, what is the harm in providing? Of course, you say that it is subjected to limited review, but limited review is not equivalent to audit. So dedicated, then where it comes to whistleblowing, as I said, you should have a dedicated email and a telephone number for facilitating anonymous whistleblowing. The internal ethics committee, you could have an internal ethics committee to weed out frivolous claims. There are claims you want to sensationalize. The managing director spent 50 crores of rupees, in his daughter's marriage. Somebody says that. So that's frivolous. Unless there is substance to it, there is no point in investigating it. So you must have an internal ethics committee. Due diligence can be conducted prior to the appointment of auditors. Now, very few companies take related party transactions seriously. I mean, they just simply adhere to the law as it stands. But importantly, it is necessary to ensure that all transactions are at arm's length. How do you assess arm's length internally? You get three tenders, and the two tenders may be your managing director's relatives, one, and you decide on L1. Is that the way to decide on, sort of arm's length. Where it comes to big ticket transactions, you can decide on arm's length authorizations based on authorizations given by big independent agencies. Like, there are rules under the Income Tax Act, the safe harbor rules for cross-border related party transactions, or also related party transactions. You could engage audit firm, tax firms for the purposes of determining arm's length pricing. Evaluation criteria for the directors is now allowed to be developed by external agencies. There has to be a top-down approach to risk management. Otherwise, you will not succeed. If you assume that risk only is at the top, risk percolates down. So it has to be. Then you have to have a risk register which is based on systems, and you should have continuous dialogue across functional heads for the purposes of identifying risks, their impact, the velocity of their occurrence, and all that. Next, my concluding musings. I have come to the last slide. I would like you to carry some questions for articulation internally. Should committees be subservient to the board? Always subservient to the board. Now, there are, as you can see, there's only one area where the audit committee has the power to decide, namely the related party transactions. Elsewhere, it is subservient to the board. And I think it should remain subservient to the board to the extent of not losing its independence. It should not only obey what the board says, it should function independently, but it should not be given the authority to decide. It should be recommendatory in nature, as it is so in case of most areas of board functioning. Now, whether the committees can be permitted to widen their scope of functioning, the answer is yes. Of course, you can. If you want to, see, please understand one thing: the company secretary is not a compliance secretary. The company secretary has to be a complete secretary. He has to, practice governance as a passion. He has to ensure that he's the linchpin. He's supposed to be the one, the go-to person where the board is concerned, where it comes to any issue which the board wants some articulation on. So, by all means, you are allowed to widen the scope of functioning of the committee. And the other thing is that, some companies feel that committees are appointed to procrastinate. Now, you can delay the decision making on a particular matter by procrastinating. Now, but the best way to procrastinate is to uh, give the problem to the committee so that the committee comes up with a solution. That should not be the attitude. The attitude should be for you to enable that company to function independently. The committee should be a very, very important resource on which the board can depend on, because at the end of the day, please remember one thing: the function of the board is to govern. The function of the board is to govern. The function of the management is to execute. Right? It should not it should not come to a situation where the board is into management. And the one way the board can function very well is through a proper functioning set of committees. And it is very imperative to ensure that you travel beyond the scope of the law where it comes to the qualitativeness associated with the functioning of committees. Finally, one last word: corporate governance is not, it's not a means to an end. It does not have a destination. It is continuous because business is continuous. And therefore, as a company secretary, we are the torchbearers of governance. And I would like to end my presentation. I mean, of course, you put the company secretary in the words which I'm going to use. I'm going to end my presentation with a quote from Robert Frost. Robert Frost was a very famous American poet, and he wrote these beautiful lines: "The woods are lovely, dark and deep, but I have promises to keep, and miles to go before I sleep, and miles to go before I sleep. The company secretary can never rest on his oars and say that I have achieved corporate governance, because corporate governance has no, it has neither a nadir nor a zenith. So it's a continuous process, and it is your responsibility to continuously innovate, encourage, and stimulate. Thank you so much. If you have questions, if there are questions on the chat box, we can spend some time. Otherwise, well, I assume that I have no idea of as to how many people have participated in this. I don't have a number on this. I don't also know whether people have participated by just keying in and not listening in, or whether they have been because the one disadvantage of a webinar is that you don't have an eye to eye contact. Then,
Yes, sir.
if you have eye to eye contact, in that case you are in a position to gauge whether you are able to engage the attention of the participants. Thank you so much. Yeah.
Yes, sir. We have received few questions from the participants.
Sorry.
Yes, sir. We have received questions from the participants.
Yeah.
And allow me, with your permission, to place the questions of the
Yes,
participants.
please, please, please. I would
Yes,
also like to know how many members are present. How
sir.
many have punched?
Sir, actually, online it has been 5,000 people, and
Okay.
currently I don't have the data, but when it will come, definitely I will share this.
Okay. Okay. Shoot the questions, please.
And so the first questions we have received, so it is, can the board meeting minutes be signed by the director at their place and send the scanned copy to the company in turn? And can company take print of that, keep it for record?
This is not a question for this discussion, but now, the convention is for the convention. This is not the law. The convention is that the minutes of the meeting are signed at the next meeting before, because the the draft minutes are circulated as per the secretarial standard within 15 days, and within 7 days the board members are supposed to give their views. So the requirement in law is to actually only reduce the minutes into writing within 30 days. There is no bar, that there is no requirement that the minutes have to be signed within 30 days, right? So if the chairman is not available, the minutes have been approved by the board, he can sign at a later date, as long as, that is why it is important, when you drop the minutes, you have to have two dates. One is date on which the minutes have been drawn up, the company secretary puts the date and signs, and the other is the date on which the chairman signs. Normally the convention, as I said, is for the chairman to sign the minutes at the next meeting, right? If supposing you have one meeting today and the next board meeting is happening 3 days later, it is not possible for you to draw up the minutes within 3 days. So you can take both the minutes at the third meeting, right? And when it comes to signature, the minute the chairman, you are supposed to sign it in the in the presence of other directors, and of course, now of course you have got. You have got, there can be digital signature also affixed on the minutes, and minutes can also be maintained electronically. So it's not, signing the minutes is not any longer a ceremony as such. But what is important is to ensure that the minutes are reduced to writing within 30 days from the date of the meeting. That's very important. Next.
Can executive director form part of the nomination and remuneration committee of unlisted public company?
Can I? What was the question?
Executive director form part of the NRC committee
See,
of unlisted public company.
okay, that there, the law, sorry, the proviso allows, the proviso says, in fact, I'll read out 179 one proviso, just 1 minute, please. 178 1 proviso says, one minute, please.
Gotcha.
Yeah. The proviso reads like this: provided that the chairperson of the company, whether executive or non-executive, may be appointed a member of the nomination committee, but he shall not chair. So the chairperson, to my mind, is not allowed to be part of the committee in terms of subsection 1. And subsection 1 says it should consist of three or more non-executive directors, right? So if you have to ensure that the independence of the committee is protected, if you have an executive director on the board, he is going to influence the functioning of the NRC because he is also interested in his remuneration, because that will be recommended by. So my view would be that you see, when the law does not prohibit the chairperson being a member of the committee, even if he is an executive, to my mind there is no bar. But I would say that you avoid. My recommendation is not to have any executive person as part of the committee. Next.
So if ultimate parent of a private company is listed abroad
Yeah.
and there, will the audit committee clause applicable?
Depends on, you see, if the ultimate holding company is not a listed company in India, why would the laws apply? The listing regulations apply only to a company which is listed in the stock exchanges in India.
So the next question is, in case
Yeah.
of RPT transaction, does approval of audit committee sufficient and no board approval required?
To my mind, there is no requirement for. See, 188 comes into play for certain 5 7 types of contracts or arrangements, and 188 does not come into application when two conditions are both the conditions are satisfied. One is it is an ordinary course of business, and second, it is in at arm's length. So if both these conditions are satisfied, 188 has no application, even if it is a transaction within the list mentioned in Rule 15. So, in my view, the approval of the audit committee is good enough. But at the same time, the approval, the audit committee's approval should be conveyed to the board. Next.
So the next question is it necessary for company to designate a executive director as a whole-time director? And can a person be an executive director without being designated as a whole-time director?
There is no difference. See, executive director, what is an executive? Who's an executive? One who has an executive function. So the law, says that whole time, uses the expression whole time director. So whole time director and executive director are synonymous with each other. Supposing you say, of course, there is one rider here. Many companies abuse the position of a director. Many companies have this habit of calling persons as directors, though they are not part of the board. You call somebody like the PSUs in particular. I remember I am seen a director finance, director marketing. He's not part of the board. May I remind you that there are two sets of circulars which have been issued by the Department of Corporate Company Affairs under the 1956 Act itself to say that if you are calling somebody as an executive director, he is not, and if he is not part of the board, then you are misleading the public, particularly if you are a listed company. So the MCA today, the MCA has clearly said that you should not allow the use of designation of executive director unless he is part of the board. So when you are talking about an executive director, I assume that this person is a director on the board. If that is so, there is no difference between a director and an whole-time executive director and a whole-time director.
So the next question is, in case of a company that is voluntarily appointing independent director and constitute audit committee, whether all provision relating to the audit committee are required to be followed?
See, if you are complying with anything voluntarily, then there is no the law does not apply. So if you want to restrict the applicability of the law to only specific matters, you are free to do so, because you are not required to apply the law, but you are doing it voluntarily. That's very good. So you can, but at the same time, if you want to, you don't want to widen the canvas to the extent the law provides, you can also restrict the application of the canvas to specific matters.
So the last question for the today is, so when RMC is formulating a business continuity plan, what should be the key component that should be kept in mind for regulatory aspects and customer aspects and for the company's continuity?
What was the question? Come back again, please.
Sir, when RMC, that is Risk Management Committee, is
Yes.
formulating a business continuity plan,
Yeah.
so what should be the key component that should be kept in that plan with respect to the regulatory aspects and the company's aspects?
See, to my mind, if you have a risk management committee to satisfy regulatory requirements, that is not enough at all. You should develop the mechanism by which you are in a position to. You should develop risk mitigating mechanisms in such a manner that you are able to survive even in difficult situations. Take the case of a company like Asian Paints. You know, so many companies collapsed at the time when, I'm not saying this as an attribute for the functioning of the risk management committee. Many companies collapsed under the weight of COVID. They lost people, they couldn't pay salaries, they closed shop, there was no business. But I recall Asian Paints was one example of a company which gave more increment to employees at that point in time, because they realized that COVID was a situation which needed financial support from the employer. And therefore, if you are having a business continuity plan merely to satisfy regulatory requirements, then I'm afraid you are not, you are just obeying the law for the sake of obeying the law. You must have a mechanism, a continuity plan which considers the vicissitudes of business and addresses the issues, addresses the concerns, the risks that are going to come about anytime in your business activity. It should be a holistic approach. You should attack risks which are controllable holistically and not merely from a regulatory perspective. Right? Then in that case, all the questions have been, if everyone's question has been answered, thank you very much for, I assume that you have given me a patient hearing. Thank you once again, ICSI, for giving me this opportunity to share my thoughts. As I said, some of the my responses are not in tune with what the fraternity feels, but I stand by my views, and I have no compulsion. I do not expect anybody to assume that what I say is right. After all, it's a free world, and there can be you can agree to disagree. Thank you very much.
Thank you, sir, for share your time and sharing the valuable insight and expertise with us. Thank you so much, sir.
Thank you. Bye bye.